Hello, everyone, and welcome back to another episode. I'm your host, Millennial Investor, and in today's episode, we are going over some piece of news that just hit the markets. If we go over here and we hit research, and we search the ticker symbol SPY, which is the S&P 500 Spider ETF, it will show this wild swing, and this is just on the day. And you see how today in the markets, we just kind of downtrended, kind of just trickled down, and then the moment we hit 1 o'clock, spike up, and then spike up again all throughout the day. And that is because what was just announced here for the United States economy from the Fed. If you look here, it says that Dow climbs 189 points to close above 33,000 for the first time ever as Fed sticks to easy policy. So all three of these indexes you can see right here, SPY, Dow Jones, QQQ, the NASDAQ, all of these indexes roared higher and many of them hitting all-time highs. And so we're going to go over why that was, what caused this, and then we're also going to give two updates, two pieces of news from my company. We're going to be looking at one with Verizon, one of the largest bond deals that has ever been done in the history of the United States and the history of the world for that matter. And then also we're going to be looking at the news that was just released for Realty Income, that they did hike their dividend a little bit, and how I'll be benefiting from that with my shares that I own here in 2021. But hope you guys enjoyed this video. If you haven't watched me before, my name is Jordan. I'm the Millennial Investor. If you want to see the companies that I own, you can see them highlighted as I'm hovering over them with my mouse right here in column A. These are the 23 companies that I currently own. This is their ticker symbols and what they pay me on an annual basis. Then I have these two charts right here. This is my annual dividend income and my monthly dividend income, and these are tracked every single month, updated at the beginning of the month, every single month. So we should be updating these in about 2 weeks from now. And then also if we scroll down, you'll see two other charts that I also track and update every single month. My portfolio value and my monthly YouTube income. I disclose my monthly YouTube income as well, like most YouTubers don't, unfortunately. I disclose everything, my buys, my sells, my dividends, my referrals, my YouTube income, all that stuff. And then I also have 5 investing goals for 2021. My annual dividend income needs to hit $600 by the end of 2021. We also need to hit a portfolio value of $20,000. We want to have at least $3,000 from YouTube income. We want to have a 150 referrals to M1 Finance, and at least 20 out of the 24 companies that I started with in 2020 to raise that dividend at least once. And then last but not least, we have my 2021 stock market prediction. And number 4 out of these 5 goals is to get 150 referrals to M1 Finance. And if you go here and you look at this brokerage, this is the brokerage that I'll be highlighting in this video and all of my videos alike. I love this brokerage. It's free to use. There's absolutely no fees whatsoever. It has some awesome features. I recommend and stand behind this company 110%. And that is why we have had 102 people sign up using this referral link. That is just me. That is just my channel. Over 100 people have signed up using this link, and that is because they love this company, they love the service, and this is why I continue to stand behind them, because they have some awesome features that I hope you guys sign up for. And you can get $10 just for getting signed up when you deposit $100, and you can help support the channel. But even if you're not interested in that, you can also check out other things as well, including my pie that is listed down below in the description, and other things as well, including savings accounts, credit card referrals, lots of other things like that. But I hope you guys enjoy this video, and let's go ahead and get started with the first piece of news. And this is the big highlight of the day. With the Dow breaking 33,000 for the first time, that mostly came off the back of the news that came out just today. So when we look at the big spike up today, it was because of the news that was just announced by the Fed Chair, Jerome Powell. The reason why we broke this record was because of what was just announced, which was that the Fed is looking at keeping interest rates at 0% through 2023. The Federal Reserve on Wednesday sharply ramped up its expectations for economic growth, but indicated that there are no interest rate hikes likely through 2023, despite an improving outlook and a turn this year to higher inflation. Okay, I'm going to show you guys a picture here real quick, and this is really important because this shows the history of interest rates, right? And this goes back to the beginning of 2020, so it stops about a year ago right in this level right back here. But what's important to see here is this little part that I'm hovering over with my mouse right here, around the 2010 to 2015 era. So those of you that know, that keep up with this economic news and the economic cycle, know that when the Great Recession hit in 2008, 2009, it took us many, many years to begin to recover. Now when the Fed saw that things were turning down, they immediately lowered interest rates to 0%. You can see here the federal funds rate at this little high point right here was, what's that, about 5.5%, and then it immediately, in just the span of a couple months, maybe a year, just immediately shot all the way down to 0. It has never really done that ever in history before. Now what the key thing to notice here is that 2010 is right here, and so they lowered that to 0% right around 2008, 2009. But they didn't even begin to raise rates even a slight amount. And we're not talking about massive raises up, not 1, 2, 3% raises up. We're talking about quarters of a percent. They haven't even begun to raise rates until about upwards of 2016. So that was about at least about a 6-year span where they kept interest rates at zero. So don't be surprised if they keep these rates at their promise at 2023. Now that sounds like a very far time. That's another full 2 years from the time I'm filming this video. But it's crazy to think about, but it's just the truth. The Fed might keep interest rates at 0% until 2023. The good news for me is that for me going to look at buying a house in the next couple of years, I think this definitely gives me an advantage if I do want to purchase a home. While the home purchase might be a little bit higher in price from what I anticipated, if the interest rate is at rock bottom prices, I'm able to pay like so little interest compared to what I would be paying if these interest rates were at 3, 4, 5, 6, 7%. So keep them at 0% will continue to further inflation, hopefully for the future, because right now inflation is at pretty much zero. It's at like 1 or 2% a year. Now the second paragraph I'm going to highlight is right here, and it says, as widely expected, the policymaking Federal Open Market Committee also voted to keep short-term borrowing rates steady near zero, while continuing an asset purchase program in which the central bank buys at least $120 billion of bond a month. I'm going to repeat that last sentence. While continuing an asset purchase program in which the central bank buys at least $120 billion of bonds a month. That is so many bonds being bought by the Fed, and that is what is keeping a lot of these bond prices at sky-high levels for such a long time. Now the good news is that some of these bond prices are starting to go down. I'm going to show really quickly one of the ETFs that I track. This is one of the main long-term treasury bond ETFs that I like to watch. This is the Vanguard Long-Term Treasury Index ETF, and the ticker symbol is VGLT. And you can see the 5-year chart here. It's pretty much right where it was 5 years ago, just slightly a couple dollars higher. And you can see that it stayed pretty low going through 2017, 2018, and then in 2020, it skyrocketed because bonds went up so high in price. The price of the bond went sky high, the interest rate of the bond went rock bottom. But the thing is now, let's look at the downtrend. You can see ever since the peak of about July, August of 2020, it's been straight down, especially heavily this past couple of months. Once we hit into 2021, once we hit this level right here, it's just been straight down ever since. So the good news is, while these companies are selling out of these bonds, a lot of these big hedge funds and a lot of these big asset managers are finally starting to sell out of these bonds, and that's why the price is going down. The yields are coming up, and they're most likely going to be investing that into other assets, more importantly into things like equities, like the S&P 500 and other investments alike. So that's once again another good news for equities, and for me personally with my investing strategy is that if you look at my companies here, if you look at the 22 companies that I own, you'll notice that the main focus that I have in this portfolio is that I am a dividend growth investor. That is my strategy. That's how I anticipate making money in the markets. I want companies that have A, great business models, B, long-term futures, 3, great dividend yields, and more importantly, number 4, they have great dividend growth. So I want to look at companies that can grow their dividend, but the bad news is that a lot of these companies, when I'm buying them at sky-high prices, I don't get the value on my money that I could be buying them at lower prices. And I'll give you a perfect example. My number one investment, like Broadcom, for example, I began buying that company like crazy in 2020. I was buying it heavily in the 200s, in the 300s, and even in the low 400s. But now we're going upwards of $500 a share, and now I'm not getting the same value from that company that I could have been buying it at just a couple months ago, just a year ago, right? So buying this exact same company at $200 a share doesn't offer nearly as much value as when you're buying it at $400 a share. So that's when we're talking about inflation, where a lot of these assets have been inflated in price, but regular traditional inflation that is measured for things such as buying goods and services are not going up nearly as fast. So keeping interest rates low are good for now, but I wouldn't mind them coming up because if it were to bring these stock prices down, in the long run, I think it would definitely benefit my portfolio, mostly being one that is focused on yield. So I definitely would like that, and it would give me an opportunity to buy bonds again, because right now, like I said, let's go back to VGLT. Right now, long-term treasury bonds, they don't yield anything. I mean, right now, the dividend yield is a little over 2%. I can get more than 3% and 4% just investing in everyday safe equities, like a Coca-Cola or a Pepsi or a Johnson & Johnson or a Broadcom. So investing in VGLT doesn't really make a lot of sense right now, and I don't really think it's a good or a bad thing, but I think mostly speaking outside of the stock market for the economy, I think it's a good thing that they're going to keep interest rates at zero till 2023, and it'll benefit me potentially buying a house in the next couple of years. But let's go ahead and move forward, and let's go ahead and look at the 2 pieces of news for my companies out of the 22 that I own. Let's go ahead and start with Verizon. Verizon targets steady revenue growth, kicks off bond sale for massive spectrum buy. Verizon is one of the few decliners in communication services after it revealed its details about its 5G spectrum auction high spending, setting the pace for its coming year at its virtual investor day. Verizon is now having a bond sale of $52.9 billion. I'm going to say it again just because of how crazy it is. $52.9 billion in bonds is what this company is selling. That's about a fourth of the market cap. That's right about a fourth of the entire company. It is financing out in bonds, not to mention the long-term debt that it already has. Now, me as an investor, how am I approaching this? I do have to say, putting on that much long-term debt is a little bit frightening. It's a little bit scary to see Verizon bring on $50 billion plus worth of debt, but that doesn't really matter a whole lot because the way that they're financing these bonds, they're financing them at rock bottom prices. Because we were just talking about interest rates, and they can finance these bonds at so low, it's absolutely ridiculous, okay? And when we look at Verizon, we look at a company that produces steady cash flows, and now with this bond sale, has more of an opportunity to grow revenues than ever before. I talked about it before, but one of the main things with Verizon is that they are very, very profitable, but they grow really, really slow. So now with Verizon, they will have the opportunity to expand their 5G network and go into the next revolution of cell phone networks, okay? So if they're able to do that and take that $50 billion and reinvest back into its business, I think that long term they can steadily get back to a place where they're growing revenues 4, 5, 6, 7%. And that'll definitely help out a big giant like Verizon. More importantly, no matter what happens, they already have a massive amount of cash flows. So financing something like a $50 billion bond deal, as crazy as the number sounds, it's something that they can definitely afford. And I don't think we'll do anything like bankrupt the company. As long as this company continues its success that it's had decades and decades on out, I think they'll be just fine. But I'll definitely be watching this company closely and seeing what they end up doing with that $50 billion, seeing if it pans out or not. I think this big of a move, $50 billion in the balance sheet, will definitely be a big make or break move for Verizon over the next decade, so we'll stay tuned with that. And then last but not least, we have a company which is my second largest holding, or I should say tied for my second largest holding. Here, we'll show my portfolio. It's 8% of my portfolio, so it's one of my largest holdings right here. Tied for second place, we have Realty Income. And I have almost $1,000 just in this one company alone. And for me, when I look at interest rates, it's once again the same thing. What's good for REITs, what's good for real estate investment trusts, is low interest rates. And that is what is happening for Realty Income. And that is what this big spike up is about over this last couple of weeks. And when we look at Realty Income, you see that it's trading at much lower of a discount than what it was in 2020. And the funny thing is that since then, interest rates have come down. And I've mentioned this before in previous episodes, but Realty Income has been able to finance some of its long-term debt at 2, 3%, sometimes even lower than that. And so when you factor in the fact that this company is still growing, outpacing that level, and that its real estate is likely to outpace that rate as well, it's kind of crazy to think that it's still trading in the 60s. So this is why it continues to be one of my number one holdings. And another reason why they continue to be one of my number one holdings is that not only does this company pay out dividends every 30 days, 12 times a year, right? But this company raises its dividend at least 4 times every year, sometimes even more than that. This company raises its dividend at least every quarter, at least every 90 days, and they just raise it again. Now, the good news is that they do raise very frequently. The bad news is that when they do raise, it's usually very small, but they are very frequent. So they did raise it 0.2%, not a whole lot. Now every share that you make did pay out $0.2345 for every share that you own. Now they pay out 0.235. So just a 20th of a cent. What is that? A 20th of a cent? If I did that math in my head right? Yeah. I think a 20th of a cent higher. So not a big raise there. But it is very psychologically motivating. Regardless, the raise isn't going to have any real material difference unless you have millions of dollars worth of the stock. But it still has a great yield, still has a lot of great growth opportunity, and still offers a lot of intrinsic value at these levels in my opinion. But overall, my portfolio is doing great. We're hitting new all-time highs in my portfolio. Continuing to reinvest, continuing to get referrals from you guys, and continuing to support my channel and support my investments. But thank you guys so much for watching. Like I said, if you want to get signed up, you get $10 just for getting signed up. And thank you guys so much for watching. I'll catch you guys next time.